Titans Woodside Petroleum and Santos have their foot firmly on the gas. Investors today welcomed the company's bumper production reports, with their shares rising strongly. Despite the recent drop-off in commodity prices, both energy producers remain optimistic about the future. Andrew Robertson reports.
It's been a good week for production reports. Mining heavyweights BHP Billiton, Rio Tinto and Fortescue releasing very good numbers. Now the focus is on energy, with Woodside Petroleum in particular really grabbing the market's attention.
With the Pluto LNG train now coming on, it's actually had a significant impact on the report in terms of increased LNG production and also increased revenues. But then when you have a look, it's also had a significant impact on the capital costs, which have diminished considerably.
Woodside's second quarter production of oil and gas was up 43% on the first quarter. Sales by volume were up 28%, while revenue rose 20%.
The clear downside with Woodside in the recent past has been Pluto and the delay in terms of ramp up there, but today's report should appease some of those concerns that investors have had, and also investors are looking for that Shell stake and some more clarity or commentary around what the future holds for that 4% shareholding.
Helped also by Woodside's upwards revision in its full-year production target, investors were more than appeased, Woodside shares jumping 8%. Santos's production report by comparison was not as exciting, but the market still liked it, with Santos shares adding 6%. Second quarter production was up just 5%, sales by volume 6%, while revenue was down 2%.
Santos has had a rough ride in recent months with concerns around the cost blowouts with their various LNG projects that they've got earmarked over the next 2 to 3 years, increasing expenditure by $2.6 billion. Some were worried about how they would fund this, whether it be via an equity raising, has seen the share price trade lower in recent months, but positive result today, an in-line result as we saw it.
Taken as a whole, Fat Profits' David Lennox says this week's production reports from both mining and energy show a resources sector still in excellent health. All eyes now, though, are on the future.
If the slough that we've seen in China now is starting to perhaps have a little more of an impact than we thought, and certainly the next quarters will again be very important to show what that trend is.
And in what could be a portent of that trend, Rio Tinto has announced it will be sacking workers at its Clermont thermal coal mine in Queensland because of falling prices.